You've heard about TQQQ, that shiny 3 times leveraged tech ETF that promises triple the gains of the Nasdaq. Maybe you're thinking it's the fast lane to wealth, watching it rocket up 40% in a month while your boring index fund crawls along. Here's the thing, you're not wrong about the upside potential, you're just catastrophically underestimating what happens when the math turns against you. Hey, it's Ollie, and today I'm going to make TQQQ genuinely click for you, because I've seen too many smart people get burned. Let me tell you about Sarah, a software engineer who thought she'd found the perfect shortcut. In early 2021, she put $50,000 into TQQQ, reasoning that if tech was going up anyway, why not triple her gains? For months, she felt like a genius. Her account hit $75,000 as the Nasdaq soared. But here's where the story gets interesting, and why I spend my time helping people understand what Wall Street doesn't emphasize in those glossy ETF marketing materials. Sarah's about to learn a very expensive lesson about something called volatility decay, and honestly, it's not her fault she didn't see it coming. Here's what Sarah didn't know, and what most people miss: TQQQ doesn't just triple your gains, it triples your losses too, and the math gets nasty fast. Let's say the Nasdaq drops 10% one day, then recovers 10% the next day. You'd think you're back to even, right? Wrong. With TQQQ, you lose 30% the first day, putting your $1,000 at $700. Then you gain 30% on that smaller amount, just $210, leaving you at $910. You're down $90 even though the underlying index went nowhere. This isn't some edge case scenario, this is how leverage works in volatile markets, every single day. But that's not even the wild part that caught Sarah off guard. Pause and guess, if the Nasdaq has a really choppy month, up 5%, down 4%, up 3%, down 6%, but ends exactly where it started, what happens to TQQQ? Most people think it stays flat too. Actually, TQQQ loses money, sometimes significantly, even when the underlying index breaks even. This is the hidden tax of leverage that compounds every single trading day. Even sophisticated investors get caught by this. Take the period from late 2021 through 2022, the Nasdaq fell about 33% from peak to trough, which meant TQQQ holders watched their accounts get absolutely demolished, losing over 80% in some cases. Sarah's $75,000 peak became $15,000 by the worst of it. The cruel irony? Some of these investors were right about tech's long-term prospects, but the leveraged vehicle destroyed them before they could be proven correct. I've seen this pattern repeat over and over: smart analysis, reasonable thesis, wrong vehicle. The leverage turns timing from important to absolutely critical. Here's the part that really gets me fired up, because it's so misunderstood: TQQQ rebalances daily, which means each day's performance compounds on the previous day's result. This works beautifully in smooth uptrends, you get that magical compounding effect working for you. But in choppy or declining markets, you're compounding your losses at triple speed while simultaneously suffering from volatility decay. It's like trying to run up a down escalator that's moving faster each day. Most people focus on the potential 3 times gains and completely ignore this mathematical reality that happens behind the scenes. So what's a smarter approach if you want amplified tech exposure? First, consider regular QQQ with a smaller position size. If you want more risk, you get the upside without the volatility decay. Second, look at individual tech stocks where you can do proper research and hold through volatility. Third, if you absolutely must use leveraged products, treat them like day trading tools, not long-term investments. Get in, get out, don't fall asleep at the wheel. The key insight that changed everything for me was realizing that time is leverage's enemy in volatile markets, but your friend in quality investments. Here's the redemptive end to Sarah's story: she learned from her mistake and didn't panic sell at the bottom. Instead, she switched to regular QQQ and individual tech names she understood, like Microsoft and Apple. Her recovery took longer than she hoped, but she rebuilt her account the right way, with sustainable strategies that could weather volatility instead of being destroyed by it. The lesson isn't that you can't make money in tech or that leverage is always evil, it's that you need to understand exactly what you're buying and how it behaves when markets get messy. Look, I get the appeal of TQQQ. We all want to accelerate our wealth building, especially when we see tech's incredible long-term trajectory. But the math is unforgiving, and I'd rather see you build wealth sustainably than get wiped out by leverage you didn't fully understand. Drop a comment and tell me, have you ever been tempted by leveraged ETFs, or do you have questions about better ways to amplify your tech exposure? I read every comment because these conversations help me create better content for you. If you want to dive deeper into smart investing strategies that actually work for regular people, check out nexusaicalls.com. I'll see you there.